Hello and welcome to this week's edition of Tax in 10 with me, Rachel de Souza and Andrew Robbins. We are both tax partners in RSM's London office and we have a wealth of experience in dealing with a wide range of private client matters. Your feedback is valuable to us, so do keep it coming, especially if you have thoughts on any topics you would like us to cover. We can be contacted at rachel.d'souza@rsmuk.com and andrew.robbins@rsmuk.com.
So, Rachel, I want to talk about a good news story this week. So it's always nice to hear about successes. And I noticed one recently that our colleague Heather Pendlebury circulated an email about the what's called the Phillips case.
Yes, I saw that, Andrew. And it was great to see that this case is still relevant in practice. And more importantly, that our colleague HMRC was successful in persuading HMRC that the Phillips principles apply to one of her clients. But hang on, let's face it, most of the people watching will have no idea what we're talking about or why we are excited. So why don't we start off by explaining in simple terms what the principles are?
Fair enough. So way back in 2006, taxpayers won a case against HMRC in a tax tribunal. The case related to IHT and the taxpayers were called Phillips. This was one of those cases where the idea of what they did was really nice. And it is something that I know we've both spoken to clients about over the years. But for various reasons, the concept is still not that widely known or actually very widely used in practice. So the basic facts of Phillips were that there was a group of family-owned companies and the group had two parts. One part was a treasury company which had a pot of cash in it, which it lent out on commercial terms to the companies in the other part of the group. And those companies then used the money for commercial purposes like buying property to develop or to rent out. So there's nothing really very special about this, except that they deliberately separated the money lending activities from the other activities. So in a lot of situations, you will have a company that's got a pot of money and it uses that pot of money to support its other, let's say, trading activities. But what Phillips did was say, well, we'll take the pot of money, stick it into a separate company and run that company to lend money properly. And the effect of doing this was that it shifted the overall activities of the group from being mainly an investment business to becoming mainly a trading business.
That's right. And that sounds really simple, doesn't it? But it's important because of the availability of business property relief, or what we refer to as BPR, for IHT purposes. And that depends on, firstly, that the company that you're looking at is a trading business. So once this has been established, the value associated with the trading elements attracts IHT relief at 100%. And what that means is that passing on that value on your death is actually free from IHT. So I guess an example would be if I am the sole shareholder of a trading business, the whole value passes to my heirs completely IHT free on my death. On the other hand, if I'm the sole shareholder of an investment company, the whole value is subject to IHT on my death. So you've got completely the opposite positions for tax purposes.
And the swing in tax charge can be huge as a result. Yep. So let's think about how this might work in practice. And let's say that we've got, today, I've got a single company and the company is worth £20 million. And the assets of my company, I've got £10 million cash, I've got a property development business worth 8 million, and I've got a couple of £1 million of rental property. Now, from a tax point of view, on the face of it, that is an investment company, because when you look at it, we've got 10 million of cash, 2 million of property rental. So more than half of my value of my company relates to an investment business. And it's only the property development part which will qualify as trading. So no BPR at all on the shares in that company. As we've just said, what Philips did was take the 10 million cash and put it into a separate company, which created a money lending business. And the point there is that that business was a trade in its own right, in the same way that a bank is a trade. Lending money to other companies on commercial terms is a trading activity. So now my 20 million group is almost all trading, because I've got a 10 million pound money lending business and an 8 million pound property development business. And my only investment element now is my 2 million pounds of property rental. So immediately, just by doing that, in principle, what I've done is that instead of paying inheritance tax at 40% on 20 million pounds, so an 8 million pound liability, my maximum IHT liability now is 40% IHT on 2 million pounds, or 800,000. So I've saved 7 million pounds of inheritance tax just by shuffling the pack a bit.
I mean, it's amazing, isn't it? And I have to say, it does sound almost too good to be true. I know that the Philips case was decided in the courts in favour of the taxpayer, but are HMRC really going to accept that just by shuffling assets around within your business, you can magically turn non-qualifying investments into IHT efficient trades?
Well, actually, I think this is one of those rare occasions when something that looks too good to be true really is true. And Aisha's success recently in her case just demonstrates that. The key is that you really have to carry on the right business on the right terms. So the Treasury company needs to take independent decisions about how it lends. It has to look at what the commercial risks are, and it has to get an appropriate return for its money. It can't just automatically provide money to other group companies whenever they want it. And I think what we saw in Philips was the fact that the people running the property side of the business actually had to have a business case and go to the Treasury company. And if the Treasury company people didn't like it, they would say no. And even though this is all a family business and it's not like you've got independent finance directors or anything, you have to look at the two things independently, and you have to be willing to be critical about the prospects of what you're lending your money on. But if you do that and you operate like any other money lender would, I think you've actually got a really good case.
I mean, what strikes me is that actually in practice, we already have a lot of clients who actually do this, as in they lend their surplus cash to their group companies, but it's not formalised in any way like in the Philips case. And for those people, really what we're talking about doing is just recognising that this is an existing activity and putting that formal structure around it. I guess in that way, lots of businesses wouldn't actually need to make radical changes to what they're doing, but they would just need to be able to show that they've got the structure and are looking at it critically, and simply just creating the different pockets for the different assets. So should we really be talking to our clients and explaining this fabulous upside of a small adjustment to how they are operating?
I think there's a lot to be said for doing it, and especially I would just add in there on the fact that you need to move things around. You need to kind of break up your company and create a group, you can actually request HMRC advance clearance for that process. So you can go, you're very upfront about this. You go to HMRC, you tell them, I am proposing to create a new treasury company. I am going to move money from one company to another to do that. Please, Mr. HMRC, tell me that you agree that there is no tax charge on that process. So the revenue won't agree that you qualify for the business property relief, but they will agree that you're not creating a tax charge by moving the things around in the first place. I would just like to end on a note of caution, though, being a natural pessimist. The Phillips structure is really fact specific. So if it's going to work, you really do have to set it up properly, and you have to operate it properly. You can't just sort of pay lip service to it. And if you try to take shortcuts, you won't get the relief. Now, Aisha's case shows that, firstly, you can expect HMRC to challenge this. You know, there's potentially a lot of tax at stake. So it's quite right and proper that HMRC would have a good dig around in these structures to make sure they worked. And you have to take it very seriously and put the time in and put the effort in to do it right. Because, again, as Aisha's case shows, that with the right circumstances, this can be successful. But I think if you don't do it right, you won't get the big tax saving that's available.
Okay, well, given us a pessimistic view to end with, how about something a bit more jolly? Have you got something nice and uplifting as a recommendation?
No.
Oh, well, that's no good.
What I've got instead is a fantastic series of gritty LA-based police detective novels. Michael Connolly is the author, and he's an ex-crime reporter, and it really shows in his writing. Very gritty, very sort of realistic, very gripping. And I'd really recommend the Harry Bosch novels. There's a whole series of them. He's you know, the rogue detective who does his own thing, but they're brilliantly written. They're totally compelling, and they're really good sort of pulp page-turning fiction. So Michael Connolly, it's not light and uplifting, but it's really entertaining. Okay.
All right. Well, that's brilliant. Thanks, Andrew. And thank you all for listening. As a reminder, do let us have any comments or feedback you have. And remember, we can be contacted on rachel.d'Souza@rsmuk.com and andrew.robbins@rsmuk.com. Bye for now.
Bye.